Welcome to Carpe Dime, a podcast about personal finance and everyday life. I'm Jamie Davidson.
Nicole Jackson from Financial Center. Thanks for spending your free time with us as we talk about how life and family affect us achieving our financial goals.
Today, we're going to break down an essential part of home buying, understanding mortgages and how they can impact your financial health.
Yep, mortgages can be intimidating, but once you get down the basics, you feel a lot more confident in making the right choices.
Yeah, so let's dive in there, Nicole. There are different types of mortgages out there, and it's important to know which one might be best for you. Nicole, let's start with a quick overview of the main types, but before that, let's talk about some stats.
Always got the stats for you, Jamie. Well, first off, 65.6% of Americans are home buyers. So there are quite a few, more than half are out there buying their own home. 47% of Americans have lived in their home for 6 to 10 years.
How long have
I
you lived
had
in yours?
about 12, I think,
12?
12,
Yeah.
13.
We're
You?
at 12 and a half right now. 12 and a half, yeah.
35% of homeowners have lived in their home for 10 to 15. So I think we kind of are right there on the cusp. You can pick which side you want to
Yeah,
believe. And then 16% have lived in their home for less than 5 years, which
okay.
I think our friend Garrett actually mentioned that he was in that same category.
Is he? 5 and
I
under,
think
huh?
so. The average length of home ownership, though, guess how long that is?
I don't know. As we're looking at this, 10 looks like that nice go-to number, but I'm sure I'm a little off there.
It's a little high. It's actually 8 years.
8
So
years?
there's that.
Okay.
And then I just have a couple more. The medium homeowner tenure is 13.2 years, which is a 3-year increase that it's done over the last decade. So it's kind of interesting to note. And last but not least, your California homeowners stay in their homes the longest. Any idea why that is?
Yeah, I think what we're probably seeing with the last two facts there, are we're seeing the market itself, the fact that the value of the homes in California continue to increase so high that it's the value is so high that you don't want to sell the home because you're going to have trouble finding another home. And a lot of people that buy those homes, they're already paid off. So why go out and get a high mortgage rate loan when you can stay in the house you're in? I think that's the other reason why we're seeing the homeowner tenure at 13.2 because a lot of people, as we're seeing in the market right now, sort of sticking in their home waiting for mortgage rates to come down because we had historically low prices 3 years prior to this. So that's probably what we're seeing. That's why that's happening. But that being said, as we look at these numbers, we know people change their minds. Sometimes people have to move, right? Sometimes life changes and you need a bigger house, or life changes and maybe you want to downsize. So there comes that time when you might have to make that decision that it's time to move, and that means you have to get a new loan. So today, let's talk about loans. We're going to talk about 7 different loans today.
7? That's a
Yep,
lot, Jamie.
7 types
7?
of loans, right? I mean, think about that. Do you think the average American realizes there's that many types of loans?
I mean, I'm not, I would never call myself average, but I don't think that I even had any idea there'd be 7 different types.
Right, 7 different types. People think there's 1 or 2 types, and usually when they're talking about them, they're talking about term, like the term of the loan. They're not really even thinking about the type of the loan. So we're going to talk about types of loan, and we can talk about terms while we're in there too. The most common one that most people are used to is the fixed rate mortgage. This is the one where it's really simple. The interest rate is the rate you get when you purchase the house, and it stays the same rate. It's fixed. It doesn't go up. It doesn't go down. It is great for long-term stability. The majority of us, when we buy our first house, are going to get a fixed term 30-year mortgage. So that's where they get in there and they're like, okay, I can afford this because it's amortized over 30 years. Once you get a little bit older, maybe you want to look at a different one. So when it comes to fixed rate mortgages, your terms can actually be 10, 15, 20, or 30 years. We saw a lot of people when the mortgage rates went down that had typical 30-year mortgages switch to 15 and 10-year mortgages. So there's that idea there.
It's kind of crazy to think about wanting to pay on something for 30 years. A lot can happen in 30 years, and just thinking about having a loan that long. I know that recently we refinanced ours, which is not where we're going right now, but we did a refinance ours to a tenant down, which is a completely other topic. But I think that is a little bit more, I see the light at the end of the tunnel on that one more than.
And you did that, and it's a fixed loan, and you did it because the rate was so low on it. You're paying a little bit more than you were used to, but you did your budget and you realized all that money you were saving by cutting that down, and you're going to save a lot of money in interest payments. So, yeah,
Exactly.
that's the majority of Americans. That's what they're in. They're in a fixed rate mortgage for one of those terms.
Another one that we should go ahead and lead into is the adjustable rate mortgage, which starts with a lower interest rate for a few years and then adjusts based on where the market is. It is riskier, but it could work if you don't plan on staying long term.
Yeah, adjustable rate mortgages, usually called ARMs. And the way they work is they are a fixed rate at first. And usually they are 3-1, 5-1, or 7-1. And what that means is if I have a 3-1 adjustable rate mortgage, my rate is locked in fixed for 3 years. And then after 3 years, my rate can go up, but it can only go up 1 percentage point per year. Okay. 5-1 arm is I'm fixed for 5 years. And then once we hit that 5 year, it can go up 1% every year until I refinance the house. And then the other one is the 7-1, which once again, think about it, the seven, you can fix it for 7 years and then it goes up 1 percentage point after that. Obviously, when you look at these, the 3-1s are going to have the lower interest rate because it can adjust much sooner than the say a seven. So a lot of times you'll see people that are like, okay, I'm just going to buy a house and have it for 5 years, and they might go with the 5-1 arm. In my past, I did a couple arms when I did refinances until I finally hooked into the really low rates a couple of years ago. With the economy the way it is right now, some companies out there might be offering arms as a way to generate some business. Typically, most people still go with the fixed rate mortgage.
I don't know that I've ever heard of an arm, really, which is weird. How many mortgages have you had?
I've had two houses, but we've refinanced them different times because when we bought our first house, the rates were high, so we refinanced. And the first one we bought, we actually bought on an arm because we were first time home buyers, and that's what they were pushing. So we waited. We went into a fixed rate before it went up, so we refinanced that one, and then we refinanced again because rates went down lower, and then we purchased our new house. And when we purchased our new house, our rate was mid fives, and I was able to get an arm. I think it was a 5 or 7 year arm at like 2.85. Then the refinance boom happened, and I took that and I switched from a 30-year arm to a 15-year fix at 2.65.
It sounds like it's really good to know what you're doing, though.
I mean, you think about it, yeah. Right now there are probably people out there asking about rates right now because they're wanting to buy a house or refinance the house. The biggest issue is the rates were so low the last couple of years, 2 years ago, that people are sort of now in shock when it comes to rates. Rates are going to come back down, but they're not going to go back down to 2.5 again. It's just not going to happen. If it is, it's going to happen in 15 or 20 years. So we're sort of stuck in this area right now where we're going to be in 7 and 6% rates. And maybe the answer is you do a 3 year arm because you're going to move in 3 years and you get it down to 5%. I don't know.
Do you have all the answers, Jamie?
No, yeah, I wish.
Are there any other conventional loans then?
Yeah, the last one is called a jumbo loan. And these are loans for more expensive homes. So if you're going out and you're buying your McMansion for, $2 or $3 million, that's probably what you're going to get is a jumbo loan. And it's because they're above what's considered the conforming loan limit. And because of that, they're going to come with stricter requirements. You're going to have a high credit score. And not only that, you're going to have to put a higher down payment down on the house. So that's a jumbo. So you and I aren't going to have jumbo loans.
You don't know that.
If you're a professional athlete, if you're not paying cash and you're getting a mortgage, then hey, I hope you get a jumbo loan. I hope you get to that. I just don't see me getting to that point in my life where I'm going to need a jumbo loan.
Listen, I have a dream of owning like the X mansion with all of the superheroes. Yeah, I'm just gonna collect them all.
I can see that. Yeah, that would be really cool. So yeah, those first three were the fixed rate, the adjustable rate, and jumbo loans, and those are considered conventional loans. And these conventional loans make up close to 45% of mortgages in the fourth quarter of 2023.
Are those available then with the majority of lenders?
They are. And with these conventional loans, people can put down as little as 3% for a conforming fixed rate loan. But some private
What does that mean?
What that means is I go buy a house and I'm going to use the number 200,000 for easy numbers. Okay. If I go buy a $200,000 house, I have to have 3% to put down on that house. So that means I have to have $6,000 to put down as my down payment. If I don't have 20% though, I'm going to have to also pay this thing called private mortgage insurance. We call it PMI. So if you go buy a house for $200,000 and you do not put down 20% on that house, which would be $40,000, you're going to also have to pay private mortgage insurance or PMI.
Gotcha. And those typically require having decent credit, like 620 and above, right?
Absolutely. Yeah. You're going to have a 620 and above for those. And remember, lower debt to income thresholds compared to some of those with others. So they're going to look at your debt to income ratio and decide if you're going to qualify for that. So a lot of times people forget about that. They go, hey, I make all kinds of money. If you make great money, that's great. But if you have high debt to income, it is going to have an impact on whether or not you get that mortgage and what that rate's going to be.
So those are all, conventional, right? Is that what theirs are
Those
called?
were all conventionals. Yeah. Now we're going to talk about government-backed loans. So tell me about a government-backed loan you learned about.
Well, I learned about the FHA loan, which is the Federal Housing Administration loan. I really kind of thought it was about farming at first, but those are ideal for buyers with lower credit scores because they require a smaller down payment.
Right.
And you can also pay as little as 3.5% down but there are mortgage insurances to help cover that as well.
Yeah, you'll have to have that mortgage insurance. And the mortgage insurance is out there to make sure that the housing market doesn't bubble out and explode again like it did before. So basically, when you're paying mortgage insurance, you're really paying for money that you're never going to see again. So the goal is always to get to that 20%, whether it's through a conventional loan or a government backed loan. Another government backed loans a lot of veterans take advantage of are VA loans. They're for veterans and military families. And the good thing about a VA loan is there is no down payment on the mortgage, nor is there mortgage insurance required. So it's a great perk and a great benefit to have if you've served in the military to get the VA loan because you can come to the table without any money down, which the majority of us don't get to do that. It's a great perk.
And the last one was the USDA loan, which I think I have like food on the brain because I was thinking it was a grade of beef or something when I was looking at these earlier. But the USDA loans are if you're going to buy in a rural area, that might be a good fit. And you can qualify for those with no down payments, but there are income limits and location restrictions in order to qualify for those. So I
Yeah,
guess you would be getting a cow. So maybe I am right.
well, I mean, USDA stands for the Department of Agriculture, so you are talking about a farm, which might have a cow, might have pigs, might have horses, might have chickens. I mean, I don't know, whatever you want to put on your farm. Knowing you, it'd
No
be
goats.
something different. No goats.
That's
Is that what
rude.
you said?
I
Oh, I
said
think.
no goats. I'm not a fan of goats. I want a horse though. That's on my next list.
Okay. So you get yourself a little USDA loan and go out and get your house in the country. So remember these three we just talked about FHA, VA loans, and USDA loans. These are all government backed loans. And as a government backed mortgage, they're loans that are obtained through a private lender, such as a bank or credit union, but insured by one of those three federal government agencies. Those would be FHA, which is the Federal Housing Administration, the U.S. Department of Agriculture, which is the USDA, or the Department of Veterans Affairs, also known as the VA. So when you're going to get one of these loans, you're going to be dealing with one of those government agencies, which is fine. They know what they're doing.
Well, that's yeah. Those lenders are taking a greater risk because they are allowing those lower credit scores or the low to no down payment options too, right?
Right. Yeah. And sometimes they can have different requirements and cost structures from the conventional mortgage. In other words, putting that money down or what your closing costs might be.
So remember that the government loan may require upfront fees and mandatory mortgage insurances.
Absolutely. Absolutely. Those are the six main ones. And then we have what is categorized as other specialized loans, which a lot of people don't know about because they are so special. Usually, specialized loans are construction loans. Some people do interest only mortgages. That's something that was kicked around for a while. A lot of banks aren't doing those anymore, but they are out there still. Renovation loans and physician loans, where it's really for something special, only for specific needs like building a home, major renovations, or profession specific financing. That's what these are for.
So is a physician loan like something that you would use to build like a doctor's office? Is that really what physician loan means? No.
No. So my wife and I did a physician's loan at one point, and like Jamie said, these are very specific loans that are overlooking certain aspects that a conventional loan might require. So in this case, physicians and other medical professionals could often carry a very high debt to income ratio when they're just coming out of school. And because of that, many loan providers will actually deny them on the spot. But lenders that do provide this special loan will often have low down payment requirements. They might have no PMI. They sometimes will have special considerations for student loans specifically. And it just depends on the loan provider in that case. Most of them will require specific eligibility requirements for the loan. So you have to be in a certain medical profession. Your income has to be verified as well as your employment status. You will still have to meet certain credit score requirements, and that'll just depend on the lender as well. And then you will often have to provide special documentation.
Okay. That's Garrett, guys. Great job, Garrett. Thanks for
Garrett?
filling in. So specialized loans, they're out there. There's needs, and I guess what you've just proven to us through your discussion is there's always a way if you can find it, right? You gotta research and do that. So we just talked
Why
about a lot of different mortgages and threw a lot in there at you. But if I'm listening to this podcast, why should I care, right? That's really what we want to get to, yeah?
Yeah, we want to talk about why these loan types matter and the impact that it has on the buyer. Because listen, if the buyer isn't impacted, they really don't care, right? I mean, impacts for them could include their interest rate, monthly payment, everything can vary depending on the type of loan that they choose. It's all about that initial decision that they make, whether it is the fixed rate mortgage, the ARM, the jumbo loan, or any of those government loans. It's going to set the stage for where they're going in the future.
So many people go out and buy their first home and they're excited and they can't wait to get the first home, but they don't know what we're discussing here. And it really has a huge impact on their finances over the long haul. I mean, we've all had that family member or the friend that bought a house they really couldn't afford on a 30-year mortgage on a rate they couldn't afford. And I can tell you, living in that house might be the greatest thing they thought, but eventually what's going to happen is they're going to settle down and they're going to realize they can't afford it. And when you can't afford something like that, that leads to a lot of stress, which leads to a lot of issues in the household. So yeah, it's really important if you're the buyer that you're doing this research, because you want to find the best deal and not over purchase and not sign the wrong type of loan. Right, Nicole?
Exactly.
And as we're talking about this, it's not just the buyers that can be impacted. It's also the sellers. Remember, there are certain type of loans that may make your property more attractive to buyers. Example would be a VA loan, right? The idea of somebody buying my house on a VA loan is good because I don't have to worry that they're not going to have the down payment because they don't have to have the down payment. Where if I'm working with somebody that's got an FHA loan, maybe their credit score is too low, or they can't come up with a 3.5% down. So we're looking at those things. Buyers may also have specific requirements on repairs based on the type of loan they are getting. FHA VA loans often require specific conditions to be met to use that. So if I'm a seller, I need to be aware of that because I can't really pick and choose based on your loan, but it'd be nice to know because it can slow things down a little bit. So really, Nicole, it comes down, what is the right mortgage? What fits your life and how do you make that decision, right?
So I would start by asking yourself questions to kind of get yourself in the right mindset, right? Like, how long do you plan to stay in the house? Are you just there for a short time? Or are you planning on hanging out until your kids graduate high school? Like, that's very different, right? What's your risk tolerance? Do you prefer a stable payment, or are you okay with your payment fluctuating as you progress through your mortgage? And then the last really big one is, what's your credit score and how much would you need to have for a down payment?
Right.
So if you haven't already started saving, that could limit some of your options there as well.
As you're doing this, there's other factors you must consider. Credit score requirements differ for each type of loan you're applying for, so make sure you're aware of those. Remember, short-term versus long-term housing, and consider the total cost of the loan over time, including interest and fees. I've known a lot of people when interest rates were going down, I'm going to refinance. But part of it was there's a fee to refinance, so you want to make sure you're going to be living in that house long enough to recoup your savings that you just put out to refinance. So there's another factor, right? Hey, if you're going to leave your house in 2 years, you probably don't want to refinance because the cost of refinancing is going to be more than you actually saved and the rates you have.
It's definitely not something that I thought about when I refinanced.
No, I think most people look at the bottom line and go, my mortgage went from Y to Z and I'm saving much a month. But they don't go, well, you just paid $3,000 up front to do this. But I didn't because they just rolled it into my mortgage for me. So, it doesn't hurt as bad, right? Yeah. So when we're talking about this, remember, conventional loans, they're their best bet if you've got good credit and decent down payment, flexible, but requires PMI if you don't come down with that 20% down payment.
The other type is government-backed loans, which are easier to qualify for lower credit scores, but sometimes come with extra fees like that FHA insurance or the VA funding fees.
And the other thing is, remember, hey, when you're looking for different loans right now, remember there are fixed rate loans and there are adjustable rate loans, the ARM. And right now, the ARM might be the way to go if you're wanting to save a little money if you're buying your first house. Fixed is going to be stable. It's fixed. The numbers, ARMs are going to fluctuate over a period of time. Most ARMs don't start fluctuating until 3 years.
Okay. So everybody, listeners, be sure you dive into your home buying process and know your options and figure out what is going to work best for you and your family and your future.
Yeah. I mean, you've been talking about possibly moving, right? I think you've learned a little bit today, haven't you? I hope so. A lot of times when we do these classes, I always think back to my younger self, and I'm sure there was somebody that had some sage advice if I had just listened. And I'm not by any means saying I have sage advice. I'm just saying learn from the things I've gone through and the mistakes I've made. And I haven't made a lot of mistakes, but I've seen a lot of people that have made mistakes. And you don't want to do that, especially with a mortgage, because it's your biggest loan you're probably ever going to get, right?
Right.
Thank you, Nicole. Carpe Dime is presented by Financial Center First Credit Union. It's produced by Jamie Davidson, Nicole Jackson, and Garrett Rude. Thanks for the advice today, Garrett. Great job.
Financial Center is an 8-time national award winner in adult financial literacy, and our goal is to what, Jamie?
to help you improve your financial life. To learn more, visit fcfcu.com.
Like what you hear? Subscribe to us on Google, iTunes, SoundCloud, the All Indiana Podcast Network, and Spotify.